Ever pondered about what's causing the fluctuating state of U.S. inflation? It's a question that's been on many minds recently, especially with the roller coaster ride that inflation has taken us on over the past year. To understand the current state of U.S. inflation, it's critical to look at how it's changed since its peak in the previous year. Inflation in the United States has been on a steady decline since reaching a high of 9.1% in June of the year before last. This might seem surprising to some, considering the economic turmoil of the past few years. However, the Federal Reserve has played a crucial role in achieving this trend, targeting an inflation rate of 2% without causing a surge in unemployment or a deep recession. Several factors have contributed to this decline. One of these is the falling prices of goods. We've seen a slowdown in the growth of housing and rental costs, a factor that has a significant impact on inflation. Wage growth, too, has cooled off, easing pressure on inflation. The Federal Reserve has been proactive in controlling inflation, projecting multiple rate cuts in the upcoming year. This has created an optimistic climate, with economists believing that inflation is nearly under control. This optimism has reflected in the stock market indexes, which have been boosted by the Federal Reserve's shift towards rate cuts. However, it's important to remember that the economy is a complex machine, with many moving parts. There are uncertainties, particularly regarding rental prices and housing costs. But the Federal Reserve remains confident in their forecast that inflation will continue to decrease. Inflation, then, isn't quite the monster it's often made out to be. It's a complex creature tamed by the vigilant Federal Reserve. Have you ever wondered how the Federal Reserve manages to steer the mighty ship of U.S. inflation? Well, the secret lies in their strategic use of interest rates, a tool they deftly wield to keep the economy on an even keel. When inflation is higher than their target, which is usually around 2%, the Federal Reserve can raise interest rates to cool down the economy. On the flip side, when inflation is too low or the economy needs a boost, the Fed can lower interest rates to stimulate spending and investment. In the recent past, the Federal Reserve has been on a mission to achieve this target inflation rate without causing a surge in unemployment or a deep recession. It's a delicate balancing act, but the Fed's recent track record suggests it's possible. Take, for instance, the steady decrease in inflation we've seen since its peak in the middle of the previous year. This decline has been attributed, in part, to the Federal Reserve's rapid rate hikes, a recovery in global supply chains, and an increase in job seekers. Looking ahead, the Fed has projected multiple rate cuts in the upcoming year to further control inflation. This sudden shift towards rate cuts has not only boosted stock market indexes but has also given economists reason for optimism. They believe that despite potential bumps in the road, inflation is nearly under control. However, uncertainties remain. There are concerns about rental prices and housing costs, which could potentially upset the balance. But Fed officials are confident in their forecasts that inflation will continue to decrease, thanks to their strategic use of interest rates. So the Federal Reserve's deft navigation is a key factor in the decline of inflation. Without their expert guidance, the mighty ship of the U.S. economy could very well veer off course. But as long as the Fed stays at the helm, we can expect smooth sailing ahead. Is inflation an isolated phenomenon, or does it ripple through the vast ocean of the economy? It's a question that captures the essence of our economic journey. As we delve deeper into the storyline of inflation, we can observe a fascinating ripple effect. Inflation, like a stone tossed into a pond, creates ripples that touch every part of the economy. One of these ripples is the surge in stock market indexes. As we've seen in recent times, the Federal Reserve's shift towards rate cuts has given a considerable boost to these indexes. This uplift reflects the optimism of investors, fueling the economic engine and fostering growth. But the ripples of inflation don't stop at the stock market. They continue to spread, influencing the very core of our economy, growth. Despite the fears and uncertainties that often accompany discussions of inflation, the economy continues to grow. The decline in inflation rates, largely attributed to the Federal Reserve's strategic rate hikes, recovery in global supply chains, and an increased number of job seekers, has helped maintain this growth. Yet, as with any economic phenomenon, there's always an element of unpredictability. Uncertainties lurk in the shadows, ready to influence future inflation rates. Rental prices and housing costs, for instance, have shown signs of instability. These factors could potentially disrupt the calm waters of our economy, causing new ripples to form. Inflation then sends ripples across our economy, influencing everything from our stock market to our job market. It's a powerful force, shaping our economic landscape in ways that are often unseen yet undeniably impactful. This understanding allows us to better navigate the vast ocean of our economy and ride the waves of change with confidence and foresight. Could a surge in productivity be the game changer for the U.S. economy we've been waiting for? Let's delve into this exciting prospect. The United States is on the brink of a potential productivity boom, a transformative shift that could have extensive benefits for the economy. This surge in productivity is being propelled by new technologies and substantial investments in infrastructure. The digital age has ushered in an era of automation and artificial intelligence, technologies that are fundamentally altering the way businesses operate and workers engage with their tasks. The pandemic served as a catalyst for this shift. As businesses and workers were forced to adapt, the adoption of digital technologies accelerated, leading to a rapid increase in productivity across various sectors. Key industries like food delivery, manufacturing, and software development have effectively leveraged technology to enhance productivity, with trends like online ordering, robot-assisted warehouses, and machine learning playing significant roles. This productivity surge isn't just about businesses getting more done, it's also leading to lower costs for goods and services, a factor that could influence inflation rates. Higher productivity means businesses can produce more at a lower cost, which can then translate to lower prices for consumers. This is a direct counterforce to inflation, helping keep prices stable even as the economy grows. Moreover, the shift towards remote work, a byproduct of the pandemic, is expected to contribute to increased productivity. Teleworking could potentially provide a sizable boost, further fueling this productivity boom. So, as we march into the future, productivity may just be the hero we need to keep inflation at bay. The dawn of this new era in the U.S. economy promises exciting possibilities. As we navigate this landscape, it's clear that productivity will play a crucial role in shaping our economic destiny.